So guys, my name is Brian Kazula. I'm with U.S. Tax Advisors Group, and we specialize in cost segregation studies and energy tax credits. But our main focus is really on cost segregation studies. So I've been doing this for a long time, and my wife still doesn't know what I do. So feel free to ask questions as they pop up, because it's not the most common topic, if you will. What we're doing essentially, in a nutshell, is we're taking a property when you purchase it, and the IRS is going to allow you to use straight line depreciation tables on commercial property over 39 years and on residential property over 27 and a half years. So they'll take that entire purchase that you have. Let's say you just bought a building for $1 million. So your basis on that building is $1 million. Then you're going to have to carve out a land allocation, because land is a non-depreciable asset. And then you're left with the remaining basis to depreciate. So let's say that the land allocation is $200,000. That would give you a basis of $800,000 to depreciate. And the IRS says you can take that and depreciate it over 39 years. The challenge with that is you're depreciating everything inside of that building over 39 years. You're not carving out any items that you can reallocate or segregate as short life assets typically with 5, 7, or 15 years. So what I want to do is just take a look at some of a couple examples of properties so you can see what we're looking at. This is a strip mall that we recently did in Southern California. The client owned the entire strip mall, and what most strip malls have, you're going to have maybe a grocery store in it. You're going to have your auxiliary stores. You may have a restaurant or two. So within that one property, you're going to have several different types of businesses that we can find different accelerated depreciation on the individual components. So looking at this picture right here of this Epic Wings, just pulling out basic things, we can see that any of the site improvements, we would reclassify from 39 years to 15 years. And what do I mean by site improvements? We're looking at sidewalks, landscaping, signage. You can see that there's site poles in the background. These are all considered 15-year assets. So you don't have to depreciate them over 39 years. And because of bonus rules, depending on when you acquired the property, you could take 100% bonus depreciation in the year that you acquired it. That was anything from September 27th of 2017 to the end of tax year 2022. In tax year 2023, bonus depreciation is starting to phase out, and now it's at an 80% bonus depreciation rate. What that means, though, it's not based on the year that you're doing the study. It's based on the year that you acquired the property. So we can do look-back studies. So we can go back and look at an asset that was acquired in 2019, 2018, and they'll still qualify for the bonus rate. So 100% bonus depreciation on short life assets. So let's keep looking at this picture. Certainly there's a sign on the building that would be considered a 5-year asset. You could look at the railing that's associated with this property, some of the external lights that you'll see on the building. We're really going to reclassify all of these assets so that you can, I'm looking at a little bit more detail. Inside that patio, that covered patio, you can see that they've got projectors, TVs, looks like ceiling fans, some decorative lighting. So all of that would be reclassified as 5-year property. So there is restaurants especially are very rich in short life assets, just because if you think about the inside of a restaurant, the carpeting, some of the buffets, the decorative lighting, those are all things that we're looking for. So now looking at residential apartment buildings. This was I think 110 unit apartment building that we did just outside of Salt Lake City earlier this year. Again, you can look at the site improvements. You can see the rocks, the landscaping. the site poles, the site signage. These roads in this community were private roads. So it's going to be the roads, the drainage, all of that is reclassified as 15-year property. Let's go ahead and look at another example. So this is a office building up in just outside of Hershey, Pennsylvania. I was there a few months ago. And same thing, an office building, we're typically going to find less short life assets inside of an office building. They're not as rich as, let's say, a restaurant, but they'll certainly have more than, let's say, a warehouse. But that also depends on the individual warehouse. I was in a warehouse not too long ago, and they'd fitted out the entire inside of the warehouse with a boom crane lift, a 15-ton boom crane lift, all the pneumatic lines that hooked up to their specialty equipment for the work that they were doing. So what we're doing is we're really carving these properties into individual components. Let's look at another example. And then certainly a simple single family residence. We see this all the time. Single family homes are, we do detailed engineering studies on the larger commercial properties. We can do a modeling study on a simple residential project because they are a little bit, simpler. Residentials or single family homes are pretty much all the same. You've got bedrooms, bathrooms, kitchen, living room, and your different components that go into them. Now, one of the things with single family residence recently over the last couple of years, it's come into play quite a bit more as, they were considered 27.5-year property, but now a lot of people are doing Airbnbs. Airbnbs, short-term use, anything under 30 days is all of a sudden it's considered 39-year property. So the structure itself, I would say you would want to depreciate that over 39 years instead of the 27.5 years. And that's based on use. So depending on the year, so if you have a long-term rental 1 year and then the next year you do a short-term rental, you would flip that on your depreciation schedules. So before I go into an example, do you have any questions on the different types of properties that we can do cost segregation studies on, or do you have any general questions on cost segregation?
Maybe I do. So
Sure.
if I have a client that owns a portfolio and they've been owning it for probably 8-10 years, I know for the fact that if you just bought the property and you do cost seg immediately, it's gonna be the best. But if he already owned that long, is that a good client for cost seg?
Yeah, so one of the things is I can't really answer that because I don't know, and the reason why it's a couple of, let's say, simple question, complicated answer. So the first thing is the longer the property's been in service, the more depreciation that's already been taken on that property. So there's going to be less of a benefit to doing the cost segregation study. However, it may still be worth doing the study on the property because we don't know, or I don't know the client's individual tax scenario. So maybe their savings really isn't there. It's not the best ROI for them, but maybe by doing the cost segregation on this property, they're able to offset that income to get them to the next tax bracket. Or maybe they're able to eliminate their taxes altogether by using that one additional property. So what I've told clients is, let's go ahead and look at all of your properties. It's a free estimate, and then you tell me which ones you want to move forward with. Meaning, I don't want to make that decision for them. And I would also, have your CPA look at it as well. Because remember, what we're doing when we're doing a cost segregation study is we're taking the depreciation or that accelerated depreciation that we're finding, and we're either offsetting active income or passive income with it in order to reduce your taxable income. So instead of doing it over the 27.5 years or 39 years, we may be able to find, let's say, 25 or 30% of the basis on that property. So let's look at that example I used earlier of a property that had an $800,000 basis. Let's say that it's a small residential property, and we're able to find 25% accelerated. So out of that $800,000, they could take $200,000 in depreciation today, year one, if they were within that 100% bonus time frame. Now, if it's 2023, it would be 80% of that, so $160,000 in year one. So it's really powerful. And to answer your question again, Tracy, because I don't know their individual tax scenario, I would say let's take a look at all of them, and then they could tell me which ones they want to use. And usually the CPA will make recommendations as well, because there's also that scenario where maybe they don't need all of it this year, but they know next year they're going to have a big income event that they need to offset a considerable amount of income. So that's one of the things too, is clients do use it strategically depending on their income, or what they've got coming up. Maybe they're planning on selling a property and they're going to have a large gain, or they know that they're going to have sales come through in their business and they're going to have a large tax bill. So what we're doing when we're looking at properties, this is just a quick snapshot of an estimate. And what we're looking at is the property address, the property type. So what type of property is it? When was it placed into service? That's going to determine, the bonus rates that we're using. Then we're going to want to look at the basis of the property, or the purchase price. Then we're going to have to carve out that land allocation. And land allocations are tricky. The thing with the land allocation is the IRS is looking for a reasonable land allocation. So what's reasonable? So what's reasonable is if you look on the county tax assessor's office, and the county tax assessor's rate looks reasonable for the area, then I would recommend using that. If you have an appraisal that has the site value listed, take a look to see if it's reasonable. The challenge that you'll find, whether it's a residential or a commercial appraisal, is most appraisers aren't using the cost approach. They're looking at market comparables. That's primarily what they're looking at. So you could also look at possibly doing, looking at market comparables for land in the area, or you could we could rebuild the property based on the construction cost data, and then we could subtract out any remainder to maybe come up with the land allocation. So what I prefer, the top three methods would be: look at the county tax assessor's records, take a look at an appraisal, or look at market comparables. You'll get your land allocation, and then you're going to have your building basis. So in this scenario, it's $557,120. And then we can also do the study on any improvements that you're going to make. So if you're going to make capital expenditures, whether it's the year that you acquire the property or in future years, you're going to want to do a cost segregation study on those improvements as well. Otherwise, what we're going to see a lot of times is the CPA is just going to drop it into that 39-year bucket or 27.5-year bucket. And in my experience, when a client comes in and they do improvements to the property, they're typically not improving the structure of the building itself. So they're improving items that are accessory to the business, meaning they're adding new flooring, they're adding new countertops or new equipment, they're upgrading electrical panels so that it supports the new ovens in the restaurant. So we're going to want to look at all the improvements that are made. So that's how we're calculating the basis on these properties so that we could do the cost segregation study. And then what we're going to do is we're going to go in and do the study. And on this estimate, you can see up top that we've got 5-year property, 7-year property, 15-year property, and then 27.5-year property. The 5-year property is going to be the interior improvements. So think about cabinetry, removable flooring covers, decorative lights, ceiling fans, PA systems, kitchen vent hoods, appliances, the appliance hookups. And I'm talking, as specific as the sink and then the drain line that runs out to the into the sewer, and then the electrical that connects the garbage disposal or the dishwasher back to the panel. So we're literally looking at all the components. Your 7-year assets are typically going to be your office furniture, maybe appliances if you have some type of manufacturing site. So that's 7-year property. And then your 15-year property is all of your site improvements. So your landscaping, your fencing, your exterior, site lights or site poles, any site signage, site drainage, even little retention ponds. Think water features. Those are all 15-year property. Everything else is going to be dropped into the 27.5-year or 39-year bucket. And on this example, what you can see is we're showing you a side-by-side comparison. In year 2, your depreciation for the remaining 26.5 years is $18,636.45. If you didn't do cost segregation, it would be $23,892. So it's not a huge difference what you're getting, for the remaining years that you own the property, but you're getting that upfront bump of, let's call it 25% of the basis of the property. So that can add a real lift today. And you're not sacrificing all of the depreciation on the building. You're not taking all of the depreciation. So it's just really powerful. So that's the estimate on the property.
I have to jump in and say something about that, Brian.
Yep.
Like I got the idea of cost seg years ago, but I didn't really know you are out there and do a very affordable cost. That's number one. And I didn't know how much is safe until I look at the estimate that you presented everybody right now. And so I really tell everybody, it doesn't matter a small property, a big property, a residential, a commercial, you need to talk to Ryan and let him do the study for you, because it doesn't cost you anything. And you'll be surprised how much saving you have even from a very small residential property. So I want to emphasize the tax saving even with a small property.
Yeah, and it scales. So we've got clients that strictly buy residential properties, single family homes, and then we've got clients that buy $22 million strip malls. So it's all relative, just depending on what you're purchasing. So if you're able to save that 25% of the basis up front, it really allows you to go buy more property or to reinvest in the properties that you have. So that's the real power of it. This slide just shows, some of the items that I went over before, the structural components of the property, land improvements, and then the personal property, the 5-year property. One of the questions that, I always like to address with clients, and I talked about the passive and active income piece. That's going to be the first question I have with a client is, can you use the depreciation that we're providing? And if you don't need it, then I don't recommend doing the study. But if you're able to use it to offset other active income, then absolutely. If you're stuck in that passive income cage because you can't use it to offset active income because you're strictly, you own a couple of rentals, but it's not your primary source of income, or you're not an active real estate professional, then just make sure it's offsetting the passive income that you have. The other piece that, I want to mention that's really important is the negatives. So doing a cost segregation study on a property, you are taking, let's call it 25% of that depreciation upfront. So you would not want to do a cost segregation study on a property that you're planning on selling in the near future, because there is going to be depreciation recapture. You're going to have to pay back what you've taken. And if you've taken a big chunk up front, that could be, a real concern. So it's not for short-term holds. Now, sometimes things come up, and Greg was talking about it with the 1031 exchanges. Things do come up and, you may have to sell that property. And that's where I really think that 1031s come in, absolutely. Just, you could do a 1031 exchange on the property and you're pushing that forward. The other thing that you could do is if you had to sell the property, you know you're going to have to pay taxes on the money, go ahead and buy another property and do the cost segregation study on the new property. And hopefully that'll be enough to offset any taxes that you have. And I think working with a good CPA, a good 1031 exchange professional is just so important. We talked about some of the items that we're looking at. I'll touch up base real quick. So you can see in the top left, any custom cabinetry. This looks like an office. Any removable flooring covers, usually think, your VCT, LVP, carpet. Unfortunately, tile is permanently affixed to the concrete, so they don't allow you to take tile as a short life asset, but you can take carpet and any removable flooring covers other than that, such as, your vinyl or your LVP. On the right-hand side of the screen, you can see decorative lighting. So this one's good because there's can lighting and then there's the decorative lighting. The can lighting is a primary source of lighting. Those, the hanging lights are decorative in nature. So we could take the decorative lights. We're going to take the cabinetry, the granite countertops, the appliances, the appliance hookups, and then, any of the custom cabinetry. So that's what we're looking at. And in this slide, I'm just showing you a quick example of the findings. So this is what your CPA would plug into your fixed asset schedule. What I'm doing is I'm breaking it up into your building or your building basis. And you can see that that's line item asset ID 1, and that's at $496,691. That's going to be depreciated over 27 and a half years. Then you're going to have asset ID 1.1. That's your asset class 57.0, distributive trades and services. That's basically anything that's associated or an accessory to the business. That's your 5-year life assets. And in this property, we carved out $147,229. And then we did not have any 7-year assets. Think of like, if it was an Airbnb, you could possibly include the furniture as a 7-year asset or any office furniture. In this one, it was a residential project and it didn't have any furniture. So we don't have any 7-year assets. And then in this one, we had about the asset class or asset ID 1.3, asset class 0.30, land improvements. We only had $13,200 on this one. So it was a smaller, it was probably, something that was more like a row home or a small multifamily project, but it just didn't have a very big site. So maybe just a sidewalk or some fencing, not much. But you can see that on this one property, their year one accumulated depreciation for tax year 2022 is $177,739. So just a huge number to help offset taxable income. So that's the slideshow I have, just introducing cost segregation. And I'm happy to answer any questions, that you guys might have on it.
Everybody can unmute yourself so you can ask questions. I guess my question is there any, well, you already said if people think they're going to sell the property, they should not do cost seg because there's a recapture. Rather than that, is there any reason that people wouldn't be a good fit for cost seg?
Yeah, so again, it comes back to that active or passive income.
Okay.
So are they an active real estate professional? Are they a licensed real estate professional? Are they a developer? Do they actively manage their properties? If they can qualify as an active real estate professional, then they're able to use the accelerated depreciation that we're providing to offset other active income. So let's say that the spouse is a high W-2 wage earner. They could use that depreciation to offset other W-2 wages because they're active. If they're strictly passive, so let's say they own 3 rental properties, but they have a property manager that manages the property and they're a W-2 employee. So they're not actively involved. They don't meet that 750 hours a year, and they're not materially participating in the management of the property. they're going to be strictly tied to passive income that they're able to offset. So if they don't have the passive income to offset, then they probably don't need to do the cost segregation study. But know that even if they don't have it, and then they can bank it, so they'll have this bank of depreciation that's going to roll over year, and then maybe 3 years down the road, they do have a big income event that's still passive, they could use it then. So it's just one of those things. It really depends on their individual tax scenario.
Okay.
So I always recommend get an estimate, talk to your CPA. We can jump on a call together, and if it works, then we'll move forward and help them out with the cost segregation study. And one of the things that you mentioned, Tracy, too, was regarding cost segregation. Is historically it's been very expensive to do cost segregation studies. Tens of thousands of dollars to do a study on a commercial project. With technology and the access to the data that we have nowadays, costs have really come down. So your commercial projects that are, let's say, over $1 million, or maybe they're more complicated, they are going to have a higher fee. They usually start at about $4,250, about $4,250 to do a cost segregation study on, let's call it a smaller commercial project, because we've got to fly up, we've got to do the site inspection, bring the data back, and then engineer the study. So it is more expensive on your larger commercial projects. On small residential projects, single family homes, duplexes, maybe quads, we can model those properties relatively easy. So then your starting point is $625 for a modeling study on a residential property for a same year study, and then $675 for a look back study. We're not flying up to those properties to do the site inspection. Most of the time, the information's available on the MLS. They had a professional photographer come out, take pictures of all the assets. I can go onto satellite imaging. I can pull the satellite views, and I can really gather most of the information through public records. So that's how we're able to do residential properties, super affordable compared to where they were. Even a small residential property was $2,500 just a couple of years ago. So, and to give you an idea of
no reason why people don't do the study with you. For that cost, everybody should do a study with you, seriously.
And thank you. And what we're doing, just so you have an idea, is we're going on, there's a RS Means is a national provider of construction cost data, and they break it down to city levels or zip code levels. So we can go into RS Means and we can rebuild a house, call it a ranch style house in RS Means, and then we'll price it at today's cost. So we'll know exactly what it costs for all the components of that property. And then we'll take the basis, the acquisition price, less the land allocation, and then we'll squeeze those numbers. So we'll prorate the numbers based on the actual construction cost data. And that's how we're coming up with our numbers. So that if you are involved in an audit with the IRS and they ask, how did you come up with the numbers? We can show them the national construction cost data, for that zip code. And, we'll show them all the build data. So historically, we weren't providing all the schedules because it was overwhelming to most CPAs and clients, but now we just provide it with all of our studies. So we'll give you the summary overview, which is a simple 1 or 2 page document. And then we'll give you the build data, which is usually about 30 to 40 pages. And that's just an Excel spreadsheet, so you can have it for your records. So that's the deliverable, if you will.
Is there a dollar amount that you should not, like, say if you bought something for $200,000, is it worth doing the cost segregation on that, or
So
is
usually
there a dollar amount that you look at?
It's I would say $75,000 is the minimum, just because you're really looking at your ROI is decreasing because it's $625 to do this study. However, I had a client not too long ago. He had like 150 properties and they were all at $75,000 or less. So it absolutely made sense for him to do the studies because he was able to offset, a tremendous amount of income or taxable income by doing it. So that's what I said earlier is I'd recommend that we just run an estimate for the client and then have them review it with their CPA, and then they can tell us if they want to move forward or not.
But the good thing is we don't really have 75,000 in Columbus anymore. So
No. You know where I'd love to invest, and I work with real estate investors all across the country, is I really love Athens. So Athens is such a cool town. So
anybody else have question for Brian? I know this is very new concept. Like he make a good joke that his wife doesn't even know what he's doing, because the very first time I heard of this concept, it took me a while to really understand what exactly cost seg. But now normally I tell my client this, well, you can do depreciation long term, you can do it now, get money now, invest now. That's the simple way that I tell everybody. So if you know any investor that wants to do this, you really have Brian talk to them. But that's normally the way I tell people, just so they can get more cash and invest in more properties.